Welcome, curious minds, to another deep dive. Have you ever looked at financial markets and felt like, well, you're watching a tempest one minute, then a perfectly calm sea the
Oh,
next?
absolutely. Those wild, unpredictable swings,
Yeah,
and then sometimes followed by these long stretches of just quiet.
exactly. What if I told you there's a powerful statistical framework that doesn't just observe these dramatic shifts, but actually helps us model and even forecast them, giving us a crucial edge in understanding market risk?
It's a profound shift in perspective, truly. To take something as seemingly chaotic as market volatility and find a structured mathematical way to understand its very pulse, it's quite something.
Absolutely. Today, we're plunging into the fascinating world of GRCH models, specifically the generalized autoregressive conditional heteroskedasticity model. Bit of a mouthful, that one.
Huh? Yeah, it is, but incredibly powerful.
Our mission today is to unpack how these tools help make sense of market volatility, explore why they became, well, absolutely essential, understand the intuition behind how they work, and maybe glimpse where they're headed next.
Right. We're aiming to distill some pretty complex academic papers and practical insights into clear, actionable knowledge for you.
This deep dive is built on a comprehensive analysis of the JRCH model, drawing from various academic papers, real-world applications, basically trying to synthesize it all.
We'll guide you through its evolution and its enduring significance in finance. It's a really interesting story.
So let's pull back the curtain on this. For decades, traditional econometric models, like the familiar ordinary least squares, or OLS, they operated on a foundational assumption that
Uh-huh.
the variance of errors in their models was constant over time. This concept is called homoskedasticity.
Sounds intimidating, maybe, but it simply means same variance throughout your data. A nice, neat assumption.
Very neat. Convenient mathematically, I suppose.
Precisely. But when you applied these models to real financial data, think daily stock returns or currency exchange rates, well, that assumption quickly crumbled.
Right. Financial time series inherently exhibit heteroskedasticity.
Which means the variance of errors changes over time. You see periods of intense, wild swings, then long stretches of relative calm. That characteristic pattern. That's what we call volatility clustering.
And here's the crucial point, the real kicker. While this changing variance, this heteroskedasticity, doesn't actually bias your OLS coefficient estimates.
Which is good, I guess.
Yeah, but it severely compromises your standard errors. They become unreliable, often too narrow.
Meaning your statistical conclusions can be completely misleading. You might confidently declare something significant when, in reality, it's just noise.
It completely skews your risk assessment. You think you're safe, but you're not accounting for the potential for big swings.
What's truly revolutionary here is the mental leap that occurred. Instead of viewing heteroskedasticity as just a problem to fix, a nuisance that violated an assumption and needed to be corrected somehow.
Yeah, like something to sweep under the rug.
Exactly. Economists began to see it as an intrinsic property of financial data. It wasn't an anomaly, it was a dynamic variance to be modeled.
Ah, okay. So not a bug, but a feature.
You got it. This profound shift was the genesis for entirely new statistical frameworks designed specifically to capture these ever-changing variances.
And that profound shift leads us directly to the birth of volatility modeling. So in 1982, a brilliant economist named Robert F. Engel published a groundbreaking paper.
This was it, the official introduction of the ARCH model, or autoregressive conditional heteroskedasticity.
ARCH.
The ARCH model was the first to allow the conditional variance of errors to change over time, specifically depending on the magnitude of past errors.
So, like volatility having a memory. A big shock yesterday makes today more volatile.
That's essentially what ARCH captured. It was revolutionary because it acknowledged that volatility itself was predictable, to some extent, based on recent history.
And Engel's legacy. Well, this work provided the very first quantitative tool for analyzing and forecasting risk, a concept that was pretty abstract before then.
Huge contribution. It's no surprise that this immense contribution earned him the Nobel Memorial Prize in Economic Sciences in 2003.
Well deserved.
Indeed. However, despite its revolutionary nature, ARCH had a practical limitation. A pretty significant one, actually.
Okay, what was that?
To truly capture the long memory of volatility, the lingering effects of shocks over many periods, an ARCH model often required including a very large number of past errors. Let's say Q past errors.
Right.
Sometimes this Q had to be really big, which meant estimating an excessive number of parameters that was inefficient, computationally heavy, and could even lead to unstable models violating constraints.
Imagine trying to model something as complex as market memory, the lingering echo of past shocks with hundreds of parameters. It just sounds unwieldy, doesn't it?
Totally impractical. Now, picture capturing that same intricate dance with just 3 numbers.
3. That's much better.
That's the sheer elegance and power of ARSH's parsimony, a true game changer in statistical modeling. That's why just 4 years later, in 1986, Tim Bullerslev, who was actually Engel's student,
Ah, the plot thickens.
right, he proposed the GARCH model, or Generalized Autoregressive Conditional Heteroskedasticity, in the Journal of Econometrics. This was the revolution.
Share RCH. Okay, so how did it generalize RCH?
GARCH allows the current conditional variance to depend not only on past squared errors, that's the RCH component we just talked about, but also on past conditional variances themselves.
Okay, wait. So not just the size of recent shocks, but also how volatile the market already was recently.
Exactly. Think of it like this. Volatility has inertia. If things were choppy yesterday, they're more likely to be choppy today, even without a new big shock. That's the GARCH component. It's like the difference between AR and ARMA models in standard time series.
Right, adding that moving average part.
Precisely. And the result of this addition, GARCH is incredibly parsimonious. It's efficient with parameters.
Like that 3-parameter example.
Yes, a simple Giratero model, for instance, uses just 3 parameters, one for the baseline variance, one for the IRCH effect, past shocks, and one for the GARCH effect, past variance. Yet it can effectively describe long memory volatility structures that would require an impractical, almost innumerable number of parameters in an RCH model.
That efficiency truly changed the game. Makes sense.
This exceptional balance between explanatory power and simplicity made GARCH quickly surpass RCH. It became the undisputed workhorse and the gold standard in financial volatility modeling.
Okay, the workhorse model. So GARCH became indispensable. But why? What fundamental problem was it solving that nothing else could really touch?
It boils down to one critical phenomenon: volatility clustering.
Right, we mentioned that earlier. Big swings follow big swings, calm follows calm.
Exactly. This was observed way back by Mandelbrot in 1963. He noted, and I'm paraphrasing here, large changes tend to be followed by large changes, whether positive or negative, and small changes tend to be followed by small changes.
We could see it, but couldn't model it well.
Correct. Before GARCH, we could observe this, but we couldn't model or forecast it accurately. GARCH gave us the first truly effective lens to do just that.
And its applications are widespread and crucial across modern finance, like in risk management.
Absolutely vital. GARCH is used for estimating measures like value at risk, VAR, and conditional value at risk, SIVAR. Financial institutions rely on these to figure out how much capital they need to hold to stress test their portfolios against extreme market moves. It's fundamental.
Makes sense. What about option pricing?
Also key. Volatility is a non-negotiable input in models like Black-Scholes, right? GARCH provides a dynamic, constantly updating, much more realistic estimate than just plugging in some static historical volatility number.
Okay, and portfolio optimization.
By accurately modeling how variances and, importantly, covariances between assets change, GARCH helps fund managers build more efficient portfolios. They can balance risk and return dynamically, not just based on long-term averages.
And I guess for active traders, especially the algorithmic ones.
Oh, yeah. Volatility forecasts from GARCH assist in adjusting positions, optimizing hedging strategies, even exploiting fleeting market opportunities based on expected volatility changes. It provides a real-time pulse of market risk that's simply unavailable with older methods.
Okay, so it's pretty much everywhere in quantitative finance.
It really is a cornerstone.
So when we look under the hood of GARCH, what are the core components that tell us about future volatility? What are those key pieces? Let's get into the weeds a bit.
Okay. At its simplest, think of it this way. A return series, let's call it IRA T for time T, is broken into 2 parts. There's a predictable average return, maybe just a constant, maybe something more complex.
Right, the mean part.
And then there's an unpredictable error or shock. Let's call it epsilon. The magic of GARCH focuses entirely on understanding the dynamics of that unpredictable error, epsilon.
Okay, so we're modeling the surprises.
Exactly. And that error term, epsilon, we can think of it as the product of 2 things. There's a random unpredictable noise component, let's call it sleek, which is just standard white noise means 0, variance 1.
The pure randomness.
Right. And it's multiplied by a scale factor, sigmoid. That sigmoid is the measure of the market's volatility at that exact moment, time state. It's the standard deviation.
Ah, okay, so epsilon equals sigmoid times state, and error CH models the sigmoid part.
Precisely. ARCH aims to model and predict that conditional volatility, sigma, or more commonly its square, sigma squared, the conditional variance.
Got it. And at its heart, a GARCH model, like the GARCH one, essentially looks at three types of information to predict today's variance, sigma squared.
Yeah, what are they?
Well, first, there's a constant term, often called omega. Think of it as the baseline level of variance the market tends to return to in the long run.
Okay, a long-run average variance.
Then there's the impact of recent market shocks. This is the ARCH part. It looks at the squared value of the previous period's error term, epsilon 1, 2. A big shock yesterday, positive or negative, increases today's expected variance. The size of this effect is governed by a parameter, usually called alpha.
Right, the reaction to news or surprises.
And finally, the model considers how volatile the market was in the immediate past. This is the GRCH part. It looks at the previous period's variance estimate, sigma T12. If variance was high yesterday, it contributes to higher expected variance today. The size of this effect is governed by another parameter, usually beta.
So omega plus alpha times yesterday's squared shock plus beta times yesterday's variance gives you today's variance estimate.
Exactly. It's the interplay of these three factors, the long-run average, the reaction to recent shocks, and the persistence of past volatility that allows JRCH to capture that volatility clustering phenomenon so effectively.
Makes sense. Now, for a JRCH model to be stable and, well, makes sense mathematically, we need to ensure that the estimated variance is always a positive value.
Right, variance can't be negative.
So those parameters, omega, alpha, and beta, generally need to be non-negative. Omega is strictly positive, alpha and beta greater than or equal to 0.
Okay, and there's another crucial condition, right, about stability.
Yes. For the market's long-term volatility to be stable and predictable, what we call covariant stationarity, the impact of past shocks and past volatility must eventually fade out. In a GRCH, 1R1, this means the sum of alpha and beta must be less than 1.
Alpha plus beta less than 1. What happens if it's equal to 1 or close to 1?
If it's close to 1, say 0.98 or 0.99, it means shocks are very persistent. The effect of a shock today will linger for a very long time in the volatility forecast. If alpha plus beta actually equals 1, that's called integrated GRC or IGRCH, it implies shocks have permanent effects on the level of variance.
Wow, okay, so that sum tells you about the persistence.
It's a key parameter. And if alpha plus beta is less than 1, you can actually calculate the long-run unconditional variance the model implies. It's just omega divided by 1 minus alpha minus beta.
Ah, connecting back to that omega term. Cool. Now, what about the distribution of those underlying random noise components, the cetas? Initially, the simplest assumption was a standard bell curve, the normal or Gaussian distribution.
Yeah, mathematically convenient again. But while simple, real financial returns often exhibit what we call fat tails.
Fat tails, meaning
Imagine a bell curve where the edges, the tails, are much thicker than a normal one. This means extreme events, like market crashes or sudden spikes, happen far more often than a traditional normal distribution would predict. The normal distribution underestimates the probability of big moves.
okay, that seems pretty important for risk management.
Crucial. We also often see skewness, where the distribution isn't perfectly symmetrical. Maybe it leans more towards negative surprises, reflecting how bad news often lands harder and creates more volatility. The left tail might be fatter than the right tail.
And that matters because choosing the right distribution isn't just some technical detail, right? It's not just fiddling with the math.
Absolutely not. It reflects a more truthful understanding of market risk and how investors actually behave, especially in response to unusual or extreme events. Using a distribution like the student's T, which has fatter tails, or a skewed student's T, which handles both fat tails and asymmetry, often gives you a much more realistic picture of potential risks compared to just assuming normality. It's about getting closer to the true picture of risk.
Right. Makes sense. Better inputs, better risk assessment.
Exactly.
Okay, moving on to the GRCH modeling process itself. You mentioned it's iterative, not just plug and play.
Definitely not. It's more like an iterative cycle of careful preparation, smart choices about the model specification, estimation, and then rigorous diagnosis. Its success truly depends on this careful, almost detective-like analysis at each stage.
So step one is always data preparation. Sounds familiar?
Yep. You start by collecting your asset price data, maybe daily closing prices. Then, crucially, you transform that into log returns, usually log, price T1.
Why log returns again?
They have better statistical properties. They're closer to being stationary, meaning the mean and variance don't drift wildly over time. Stationarity is a foundational assumption for most time series analysis, including GRCH. You typically test for stationarity using something like the augmented Dickey-Fuller test.
Okay, log returns, check for stationarity. What's next?
Once your return data is ready, you might build a model for the average returns first. Maybe a simple constant mean, or maybe an ARMA model if there's some predictability in the returns themselves. The goal is to filter out any patterns there, leaving you with clean errors or residuals, those epsilons we talked about.
Get the predictable part out, focus on the unpredictable shocks.
Exactly. Then you test for the presence of the ARCH effect in those clean residuals. This is critical. Does volatility seem to depend on past shocks?
How do you test for that?
You can do it visually first. Plot the autocorrelation function, ACF, of the squared residuals. If you see significant spikes that decay slowly, that suggests volatility clustering.
Okay, look at the squared errors over time.
Right. Or, more formally, you use a statistical test like the RRCHF-LM Lagrange multiplier test. The null hypothesis is no RCH effect. If the p-value is small, you reject that null, meaning there's an RCH effect, and using a GARCH model is appropriate.
Got it. So, confirm volatility clustering exists before fitting GARCH. Makes sense.
If you have that green light, next comes selecting the model's orders, P and Q, and estimating its parameters. Remember, GRCHPQ odd P is the number of past variances. Q is the number of past squared errors.
How do you choose P and Q?
While you can look at more complex diagnostic plots of the squared residuals ACF and PACF, a common and effective approach, especially given GR's read power, is to simply try out a few small, prominent orders, like 1, 1, maybe 1, 2, 2, 1, 2, 2.
Keep it simple initially.
Exactly. Then you estimate each of these candidate models and choose the one that best balances complexity and how well it fits the data using criteria like AIC, a Kayaki information criterion, or BIC, Bayesian information criterion. Lower values are better. BIC tends to penalize complexity more heavily.
Okay, AIC-BIC help pick the best parsimonious model. How are the parameters, omega, alpha, beta, estimated?
They're estimated using a technique called maximum likelihood estimation, MLE. Essentially, MLE finds the parameter values that maximize the probability or likelihood of observing the actual data you have, given your chosen GRCH model and assumed distribution for the errors, like normal or student's t.
Okay, find the parameters that make the data look most likely.
That's the idea. Then comes the truly crucial step, model diagnosis. This is where you rigorously test how well your chosen and estimated GRCH model actually captured all the volatility patterns. You don't just assume it worked.
How do you diagnose it?
You do this by analyzing the model's standardized residuals. These are the raw residuals, epsilon, divided by the model's estimated volatility sigma at each point in time. So it's T equals epsilon sigma.
Well, back to those ZTs, the underlying noise.
Exactly. If your JRCH model is correctly specified, these standardized residuals should essentially be pure, unpredictable white noise. They shouldn't show any remaining patterns, especially volatility clustering, and they should follow the distribution you assumed, normal, T, etc.
So you're looking for truly clean residuals now. How do you test that?
Several ways. You use statistical tests like the Jung-Box test. You apply it to the standardized residual, DS themselves, to check for any remaining linear autocorrelation. And most importantly, you apply it to the squared standardized residuals, DE2, to ensure all the volatility clustering has been captured.
Wow.
You want high p-values here, indicating no significant patterns remain.
Okay, Jung-Box on ZT and ZT squared. What else?
You can also run the RCH-LM test again, but this time on the standardized residuals just to double check for any leftover ARCH effects. Again, you want a high p-value.
Makes sense. Check if the cleaning process worked.
And a particularly important one for financial markets is the sign bias test, developed by Engel and N. This test helps you detect if your standard symmetric GRCH model is actually missing something important, the leverage effect.
The idea that bad news hits volatility harder than good news?
Exactly. The sign bias test looks for correlations between the squared standardized residuals and lagged negative residuals. If the test's p-value is small, it's a strong red flag. It suggests negative shocks have a different impact than positive ones, and you should probably consider an asymmetric JRCH model instead.
Okay, that's a key diagnostic for choosing between symmetric and asymmetric models.
Definitely. And finally, visual checks are essential. Plot the ACF of the standardized residuals, CIDE, and their squares, CST2. You want to see no significant spikes. Also, use a QQ plot, quantile plot, to visually compare the distribution of your standardized residuals against the theoretical distribution you assumed, like normal or student's t. If the points fall roughly on a 45-degree line, the fit is good. Deviations, especially at the tails, indicate if your chosen distribution is capturing things like fat tails correctly.
So it's a mix of formal tests and looking the pictures.
Absolutely. This whole diagnostic process is truly like an investigation. It helps you understand what the model captured and, perhaps more importantly, what it missed. It guides you on whether you need to refine the model, maybe change the order, try a different distribution, or switch to an asymmetric model.
And if your model passes this rigorous inspection, all the tests look good.
Then you can have some confidence in it, and you can then use it for its main purpose, forecasting future variance, signet plus H2.
Right. Okay. That's a thorough process. Now, let's talk about the practical considerations regarding data and fine-tuning your GRCH model. First, the data requirements. GRCH is primarily designed for financial time series, right?
Yes, things like stock returns, market indices, exchange rates, commodity prices, that kind of data where volatility clearly changes over time.
And that raw price data needs to be converted into log returns for better statistical properties and stationarity. We covered that.
Right. As for frequency, higher frequency data, like daily data, generally performs much better
Why is that?
because it simply provides more observations, more data points to capture the volatility dynamics accurately. You see the clustering more clearly. Lower frequency data, say monthly or quarterly, often lacks sufficient volatility signals. The averaging smooths things out too much, making it hard for GRCH to pick up the patterns effectively, leading to potentially unreliable estimates.
Got it. More data points are better for seeing the changes. What about sample size overall? How much data do you need?
GARCH does require a relatively large data set for stable and accurate parameter estimation, especially with maximum likelihood. Research suggests you probably need a minimum of 500 observations for a basic GARCH model to avoid significant estimation biases and problems with the estimation algorithm converging. More is generally better, especially if you're considering more complex models. Maybe 1,000 or more is safer.
Okay, so think years of daily data, not just a few months.
That's a good rule of thumb, yeah.
When it comes to important parameters and tuning, you mentioned the GRC-1 model is often the recommended starting point.
Yes, definitely. It's remarkably powerful and flexible for most financial series. It captures the core dynamics, mean reversion, clustering, persistence, with just those three parameters. Start there.
And for selecting the optimal orders, PQ, if 1, isn't quite right.
You iterate through small values, like we discussed, 1, 2, 2, 2, estimate each, and then use those information criteria, AIC or BIC, to select the model with the lowest value. It helps you choose the most parsimonious model that still fits the data well, avoiding unnecessary complexity.
Okay. And the choice of distribution for your standardized residuals, you stressed its economic significance earlier.
Absolutely. Don't just blindly use the default Gaussian or normal distribution. It often fails to capture the fat tails of real financial returns.
Meaning it underestimates the chance of extreme events?
Exactly. The student's distribution is a very popular choice, precisely because it does have fatter tails. It often provides a much better fit and more realistic risk assessments, especially for things like value at risk.
What about skewness, if bad news hits harder?
Then the skewed student Z distribution is often even better. It captures both the fat tails and any asymmetry or skewness in the distribution, like the negative skewness often seen in stock returns.
Are there others?
Yes, the generalized error distribution, GED, is another flexible option that lets you control the peakedness and tail thickness. The key takeaway is to test different distributions and see which one best fits your standardized residuals during the diagnostic phase. This choice isn't just technical. It helps the model truly reflect the market's actual risk profile.
Right. And finally, the mean model, the predictable part of the return.
Yeah, you have choices there too. Often, just assuming a mean constant is sufficient, especially for daily returns which are close to zero on average.
Okay.
Sometimes, if the series has already been adjusted, you might use mean zero. Or, if you suspect there's some autocorrelation in the returns themselves, like yesterday's return predicting today's, you might specify an AR, MA, or ARMA structure using something like mean ARX. The goal is always to filter out the predictable part to get cleaner residuals, epsilon, for the GRCH model to work on.
Okay, so prepare data, check for ARCH, choose orders, start with 11-1, choose distribution, probably not normal, estimate, and then diagnose thoroughly.
That's the workflow in a nutshell.
Once your model is estimated, performance evaluation and diagnosis are non-negotiable steps to determine its reliability. Let's talk about evaluating the fit. How do you measure in-sample fit?
In-sample fit measures how well the model explains the data it was actually trained on. One key metric is the log likelihood value from the MLE process. Higher values, closer to zero since they're usually negative, indicate a better fit to the data.
Okay, higher log likelihood is better.
You also use those information criteria, AIC and BIC again. Lower values are better here because they balance the goodness of fit, log likelihood, with model complexity, number of parameters. They help you avoid overfitting, choosing a model that's overly complicated and fits the training data perfectly, but doesn't generalize well.
Right. Don't want a model that just memorized the past.
Exactly. Because the real test for any forecasting model is its out-of-sample forecasting ability. How well does it perform on data it hasn't seen before? That's what really matters.
How do you test that?
The standard method is backtesting. You split your historical data into an in-sample period for training the model and an out-of-sample period for testing. You estimate the GRCH model using only the in-sample data, then generate forecasts for the out-of-sample period, say one step ahead at a time, possibly re-estimating the model periodically as you move through the test set.
Okay, train on the past, test on the future, hold out data. Then what?
Then you compare your model's variance forecasts, segment 2 forecasts, to some measure of actual volatility in the out-of-sample period. Common forecast error measures like mean squared error, MSE, or mean absolute error, MAE, can tell you how accurate your predictions were, on average. Smaller errors are obviously better.
But wait, how do you measure actual volatility? You said it's unobservable.
Excellent point. That's the challenge. Latent volatility is unobservable. The most common proxy used historically is simply the squared return, or squared residual epsilon 2, for that period.
But you said that's noisy.
It's extremely noisy. A big squared return could be due to high volatility, or just one large random shock, a big seat, in a period of low volatility. So evaluating GRCH forecasts against squared returns isn't ideal, but it's often done.
Is there a better way?
Yes, especially with the availability of high-frequency data. More advanced research often uses realized volatility. This is calculated by summing up squared intraday returns, like 5-minute returns, over a day. This provides a much less noisy, much more accurate measure of the actual volatility that occurred during that day. Evaluating GRCH forecasts against realized volatility is considered a much more robust approach if you have the intraday data.
Okay, realized volatility is a better target possible. And those key diagnostic tests we talked about, lung box, RSE-HLM, sign bias, are they relevant for evaluation too?
Absolutely. You should run them on the standardized residuals from the out-of-sample period as well. Do they still look like white noise? Did the model continue to capture volatility clustering outside the training set? Did the leverage effect seem to persist? It helps confirm if the model's properties held up on new data. Visual checks on the out-of-sample residuals are also crucial.
Right. So diagnosis isn't just a one-time thing during model building.
No, it's ongoing. This whole process is an investigation, helping you understand not just how well the model fit the past, but how well it actually predicts the future and where its potential weaknesses might lie.
Got it. So let's summarize the strengths and limitations of GRCH. What's the good news?
Its primary advantage, its reason for being, is its ability to capture volatility clustering. It beautifully models that observed phenomenon that large financial changes tend to be followed by other large changes, and small by small. That's its core strength.
And the parsimony.
Huge advantage. It's incredibly parsimonious. A simple Jenner one can describe complex, long memory volatility structures with far fewer parameters than an equivalent ARCH model would need. This significantly reduces the risk of overfitting and makes estimation more stable.
What else?
Plus, when the stationarity condition, alpha plus beta 1, is met, GRCH implies mean reversion and volatility. Volatility might spike, but it's expected to eventually return to a long-run average, which aligns with how markets generally behave over longer periods.
Okay.
All this leads to significantly improved forecast accuracy for volatility compared to simpler models that assume constant volatility. And it offers a flexible framework that can be extended in many ways, different distributions, asymmetric effects, adding other explanatory variables. It's a solid foundation.
Okay, those are strong points. But what about the limitations? What are the downsides of standard symmetric GARCH?
The most serious one, especially for stock markets, is that standard GRCH doesn't capture the leverage effect.
Because it uses squared errors, right?
Yeah.
It treats good and bad news the same.
Exactly. Because the variance equation depends on squared errors, epsilon 2, 2. It reacts symmetrically to shocks. A negative shock of negative 2% and a positive shock of plus 2% had the exact same impact on the next period's forecasted volatility. This contradicts the reality often observed in stock markets where bad news, negative returns, typically increases volatility significantly more than good news positive returns of the same magnitude.
That seems like a pretty big miss for stocks.
It is. It's arguably the most significant limitation. Also, those mathematical constraints needed to ensure positive variance, omega 0, alpha equals 0, beta equals 0, 0, can sometimes be too restrictive during estimation, causing numerical issues.
Anything else?
Well, GARCH is purely statistical, or stochastic. It offers no direct economic explanation for the source of volatility changes. It describes the patterns, but doesn't say why volatility went up. Was it news, policy changes, sentiment? It can also be quite sensitive to outliers. A single massive shock, like a market crash, can make the alpha term spike and persist in the volatility forecast for a very long time due to the beta term, potentially overestimating risk long after the event.
Okay. And it assumes the speed of response is constant.
Yes, it assumes the same speed of mean reversion, regardless of how far volatility is from its long-run mean, which might not always be realistic.
So, putting it all together, when does GARCH truly shine and when might it stumble in the real world?
It generally works well in high-liquidity, well-functioning financial markets. Think major stock indices like the S&P 500, major currency pairs like USD, especially when you use high-frequency data like daily or even intraday data. It tends to perform best during relatively stable market periods where the underlying dynamics aren't drastically changing.
And where does it work poorly?
It often works poorly during periods of structural breaks. Think the 2008 global financial crisis or the onset of the COVID-19 pandemic. These events fundamentally change market dynamics, investor behavior, and underlying relationships in ways a standard GARCH model, estimated on pre-crisis data, just can't anticipate. The parameters themselves might shift.
Okay. Regime changes are tough. What else?
It also naturally struggles in markets with strong, undeniable leverage effects, particularly stock markets, if you're using a standard symmetric GARCH. That's where you really need the asymmetric models. Low-frequency data, like monthly or quarterly, isn't ideal either, as we discussed. And if volatility seems to depend on extremely complex, nonlinear factors or interactions, maybe involving sentiment data or macroeconomic variables in weird ways, then more flexible machine learning models might actually capture those patterns better.
And this limitation, especially the asymmetry issue, is what spurred the development of all those other GARCH variants, the GARCH zoo.
Precisely. The need to address the leverage effect primarily, but also other nuances, led to a proliferation of different GARCH-type models. This offers great flexibility, but also creates a bit of a model selection problem. Which one do you choose?
Right. Okay, to make this more concrete, let's put GARCH in action with some real-world case studies. You mentioned there's no single best GARCH model for all assets or times. Absolutely not. Performance truly depends on the market regime. Is it calm? Is it chaotic? And the specific characteristics of the asset you're modeling. Okay, case study 1, S&P 500 volatility. What do we see there? This is probably one of the most studied indices. Its returns clearly exhibit both strong volatility clustering and a pretty significant leverage effect, which becomes especially apparent during crises like the dot-com bubble crash, the 2008 crisis, and the COVID-19 shock.
So bad news definitely hits harder.
Generally, yes. Studies often find that a basic GARCH 1.1 is a decent baseline model. The estimated parameters, particularly beta, are often very high, and the sum alpha plus beta is usually very close to 1, maybe 0.95 to 0.99.
Indicating high persistence. Shocks linger for a long time.
Exactly. Volatility is very persistent in the S&P 500. Because of that pronounced leverage effect, asymmetric models like EGAR or GJRGish often provide a statistically better fit when you look at historical data in sample. The parameters that capture asymmetry are usually significant.
Oh, you mentioned something earlier about forecasting.
Right. What's fascinating, and perhaps counterintuitive, is that when it comes to out-of-sample forecasting predicting future volatility, it's not always clear that these more complex asymmetric models consistently outperform the simple GARCH A111. A famous study by Hansen and Linde back in 2005 compared hundreds of GARCH models on exchange rate and IBM stock data and found that for IBM stock, no model consistently beat the GARCH for forecasting, even though asymmetric models fit better historically.
So better historical fit doesn't guarantee better future predictions.
Not always. It really highlights the importance of out-of-sample testing and considering factors like the specific data period and the performance metric used. Parsimony can sometimes win out in forecasting.
Interesting. Okay, next case. Let's shift to an emerging market, the VN Index volatility in Vietnam. What's different there?
As an emerging or frontier market, it naturally experiences higher baseline volatility compared to, say, the S&P 500. It can be more influenced by rapid economic shifts, policy changes, foreign investment flows, and sometimes perhaps stronger herd behavior among investors.
Do we still see clustering and fat tails?
Oh yes, studies consistently confirm both volatility clustering and fat tails are present in VN index returns. What's interesting is the leverage effect. Some earlier studies, maybe using data from calmer periods, sometimes found that a standard GRH or even a simple R1 model was sufficient and didn't find strong evidence of a leverage effect. Some even hinted at a bull market effect where positive news increased volatility more.
But what about more recent studies?
More recent studies, often using longer data series that include significant downturns or crises, do find evidence of the leverage effect becoming more apparent. These studies tend to prefer asymmetric models like GARCH and GARCH. For example, a study I saw from the University of Kebangsaan, Malaysia, looked at VN index data and found statistically significant parameters for the leverage effect, indicating that negative shocks did indeed have a disproportionately larger impact on volatility, especially during certain periods.
So the market structure might be evolving, or maybe you just need enough crisis data to see the leverage effect clearly.
Could be either or both. It shows how results can depend on the time period study.
Okay, third case study. USD exchange rate volatility, the biggest market in the world. What's the story there?
Right, the largest and most liquid financial market. Volatility clustering is definitely present here too. You see periods of calm trending followed by choppy trading. However, unlike stock markets, the leverage effect is often found to be much weaker or less clear-cut.
Why would that be?
Well, exchange rates aren't directly tied to a company's balance sheet or leverage in the same way a stock price is. While bad economic news for a country might weaken its currency and increase volatility, the asymmetry isn't usually as pronounced as in equities.
So what models work well for USD?
Often, a standard, symmetric GRCH one-on-one model, but importantly, combined with a fat-tail distribution like students' T or GED, performs very well. While some studies do find statistically significant asymmetry sometimes, many conclude that the symmetric ERCH other one still provides comparable or even slightly better out-of-sample forecasts.
Interesting. So symmetry might be okay here, but capturing the fat tails is crucial.
Exactly. It suggests that other fundamental factors like interest rate differentials between the Eurozone and the US, central bank communications and interventions, or major geopolitical events might be more important drivers of FX volatility than the leverage effect itself. We also tend to see very high persistence here, with alpha plus beta often very close to 1.
These case studies really drive home the point. Model selection is context-dependent. There's no one-size-fits-all.
Precisely. You need to understand the asset, look at the data, run the diagnostics, and test out a sample.
So let's put GARCH in a broader context now. First, a quick recap comparing GARCHs versus ARCHs.
GARCHs is unequivocally superior in almost all practical applications. Why? Parsimony. A GARCH can effectively represent a much more complex, high-order RCH model, capturing long memory effects with just those 3 parameters. RCs would need potentially dozens or hundreds, making it inefficient and prone to estimation problems. GARCH offers a more flexible lag structure naturally.
Okay, GARCH wins over ARCH. Now, GARCs versus asymmetric GARCH, delving into that GARCH a bit more, their main purpose is to address
the leverage effect. That failure of standard GARCs to account for negative shocks having a bigger impact on volatility than positive shocks of the same magnitude.
What are the main workhorses in the asymmetric series?
2 key ones stand out. First, GARCH, exponential GARCH, proposed by Nelson. It models the logarithm of the variance. A neat trick here is that because the log can be anything, the variance itself, being the exponential of the log, is always guaranteed to be positive. So you don't need those potentially tricky non-negativity constraints on the parameters during estimation.
Clever. And how does it handle asymmetry?
It includes terms that explicitly depend on both the magnitude and the sign of the past shock. ZD1. There's usually a parameter, often called gamma, that captures the asymmetric impact. If gamma is negative and significant, it means negative shocks increase volatility more than positive shocks.
Okay, EJRSH models log variance, avoids constraints, uses gamma for asymmetry. What's the other big one?
GARCH, named after Gloston, Chaganathan, and Runkle. This one keeps the standard GARCH structure for variance itself, but adds an extra term that only kicks in when the previous shock was negative.
How does that work?
It uses an indicator variable that's equal to 1 if the previous shock, epsilon 1, was negative, and 0 if it was positive or 0. This indicator multiplies the squared shock term. So a positive shock contributes alpha to the variance, but a negative shock contributes alpha plus gamma, where gamma is the coefficient on this extra term. If gamma is positive and significant, it directly measures the additional impact of negative news, the leverage effect.
Ah, so GJR adds an explicit extra kick for negative shocks. Seems intuitive.
It's very popular for its interpretability. There are others too, like APARCH, asymmetric power RCH, which is very general and actually nests many other GRCH models, including Setter GRC, GJR, and others, as special cases by allowing you to model a power of the standard deviation and including leverage terms.
So lots of options if the sign bias test tells you asymmetry is present.
Definitely. The choice between them might come down to statistical fit, AIC-BIC, diagnostic checks, and sometimes ease of interpretation.
Okay, now the big modern comparison, GRCH versus machine learning ML models like LSTMs, long short-term memory networks. How do they stack up?
It's a really interesting comparison because they come from fundamentally different philosophies. GRCH is rooted in econometrics. It's theory-driven, based on financial time series properties, highly interpretable, we know what alpha and beta mean, but it makes specific assumptions, like the equation form the distribution, and has limits on capturing really complex nonlinearities. It usually works well with moderate amounts of data.
And machine learning.
ML models, like LSTMs, come from data science. They are primarily data-driven. They can learn extremely complex nonlinear patterns directly from vast amounts of data without strong prior assumptions about the underlying structure. The downside, they often act as a black box. They might give good predictions, but it can be very hard to understand why or what specific factors are driving the forecast. And they typically require very large data sets to train effectively.
So interpretability versus flexibility, theory versus data.
That's a good way to put it. But what's really fascinating now is that the debate is moving beyond either towards integration.
Hybrid models.
Exactly. Hybrid models, such as combining GARCH features with LSTMs, are showing a lot of promise in research. The idea is to leverage the strengths of both.
How would that work?
You could use GARCH to first model the core volatility dynamics and generate meaningful features like the conditional volatility forecast, segment itself. Then you feed that GARCH output, along with other relevant data, maybe returns, volumes, sentiment indicators, into an LSTM or another ML model. The ML part can then focus on capturing any remaining complex, nonlinear patterns or interactions that the GARCH model might have missed.
Ah, so GARCH provides a theoretically sound baseline and interpretable input, and ML adds the nonlinear finesse.
That's the hope. You try to get the best of both worlds. Some interpretability from the GARCH component combined with the potentially superior predictive power of ML for complex dynamics. It's an active area of research.
Very cool. Okay, based on everything we've discussed, what are your top recommendations for actually optimizing and tuning a GARCH model in practice?
All right, practical tips. First, always start with A-chart if you're a benchmark. It's powerful, parsimonious, and often surprisingly hard to beat consistently, especially out of sample.
Don't overcomplicate unnecessarily.
Exactly. Second, always check for the leverage effect, especially in equity markets. Use the sign bias test on the residuals of your initial Gailey chart. If it's significant, low p-value, seriously consider switching to an asymmetric model like eGARCH or GJRCH.
Right. Address the asymmetry if the data demands it.
Third, choose an appropriate distribution for the standardized residuals. Don't just default to normal. Test the student's T, skewed student's T, or maybe GED. Use QQ plots and goodness of fit test to see which one best captures the observed fat tails and skewness in your data. This significantly impacts risk assessment.
Better distribution, better VR estimates.
Precisely. Fourth, prioritize out-of-sample evaluation. Don't just pick the model with the best in-sample AIC or BIC. The real test is how well it forecasts on unseen data. Use backtesting on a holdout dataset. Compare forecast accuracy using metrics like MSE or MAE, ideally against realized volatility if possible.
The proof is in the prediction.
Absolutely. And finally, balance complexity and efficiency. Remember parsimony. While a GR2 with a skewed T distribution might fit slightly better in sample than a GR11 sample one with a regular T distribution, will it actually forecast better? Is the extra complexity worth it? Sometimes simpler is more robust. Use AIC-BIC as guides, but let out-of-sample performance be the ultimate judge.
Great advice. Start simple, test for asymmetry, pick the right distribution, focus on forecasting, keep it efficient.
That's the core strategy.
Looking ahead now, what are the future directions for GARCH modeling? Where is the research heading?
One huge area is extending these ideas to multiple assets simultaneously. That's the realm of multivariate GRH, or MGRHH. Instead of just modeling the volatility of one stock, you want to model the volatilities and the time-varying correlations between, say, all the stocks in a portfolio.
That sounds essential for portfolio management or risk analysis across markets.
It is. But it's incredibly challenging due to what's called the curse of dimensionality.
Meaning,
As you add more assets, the number of parameters you need to estimate in the model just explodes. A simple bivariate GREH, 2 assets, might be manageable, but modeling the full covariance matrix for even 10 assets, let alone 100, with complete flexibility becomes computationally infeasible very quickly.
so how do people handle that?
They develop more constrained but still useful MGRAHH models. An early approach was the CCC, constant conditional correlation model, which assumes correlations are constant over time, only variances change. That's often too simplistic.
Correlations definitely change, especially during crises.
Exactly. A major improvement was the DCC, dynamic conditional correlation model, developed by Robert Engel again in 2002. DCC models the variances of each asset using individual GRCH models first, and then models the correlations using a separate, more parsimonious GRCH-like process. It allows correlations to change over time in a manageable way and has become extremely popular.
DCC sounds like a practical solution. Are there others?
Yes, models like Beck, named after Baba, Engel, Kraft, and Kroner, offer another structure that ensures the resulting covariance matrix is always positive definite, a necessary mathematical property. But it can still involve many parameters. MGRCH is vital for understanding things like volatility spillovers between markets, for dynamic asset allocation, and for designing effective cross-hedging strategies.
Okay, multivariate GARCH is a big frontier. What else?
The other major directions involve integrating GRCH with new data sources and techniques like we touched upon. The hybrid GRCH ML models are a hot area, trying to get the best of both worlds.
Combining structure with flexibility.
Right. And the use of high-frequency intraday data is becoming increasingly important. This brings us back to realized volatility.
The better measure of actual volatility derived from intraday return.
Yes. Instead of just using realized volatility to evaluate standard GARCH forecasts, why not incorporate it directly into the model itself? This led to the realized GARCH model, developed by Peter Hansen and collaborators around 2012.
How does realized GARCH work?
It explicitly includes realized volatility, or other realized measures like range, in the GARCH variance equation through a separate measurement equation. This allows the model to leverage the richer, more timely information contained in intraday data directly when forecasting volatility for the next day. It essentially links the daily volatility dynamics to the observed intraday patterns.
And does it work better?
Studies show it significantly improves forecasting performance compared to standard GARCH models that only use daily returns. It makes intuitive sense. You're giving the model much better, more direct information about current volatility levels.
So what does this all mean for you, the listener? The future of GARCH isn't just about creating more variations in the zoo, is it?
No, I think it's more about its integration as a fundamental, interpretable building block within larger, more sophisticated frameworks.
Right. To tackle increasingly complex problems like modeling vast portfolios or incorporating alternative data, and to leverage new data sources like high-frequency prices, GARCH remains essential. It serves as that robust, theoretically grounded foundation upon which new, more powerful, perhaps hybrid models can be built.
It's still the starting point for serious volatility modeling.
And that wraps up our deep dive into GARCH models. Wow, we've really covered some ground. We've journeyed from recognizing changing volatility as a persistent problem in early finance
To embracing it as an intrinsic, modelable property of financial data.
leading to the development of these powerful, adaptable models, RRCH and especially GARCH, that are now absolutely essential for navigating modern financial markets.
We've explored its origins with Engel and Bullerslev, the core intuition behind how it captures clustering and persistence, its widespread applications, its strengths, its crucial limitations like the leverage effect.
And how that spurred the development of the GARCH, and how it compares to and is now integrating with machine learning. We've seen how it performs in different markets through case studies, and looked at where it's heading with multivariate and realized GARCH models.
It's a model that has stood the test of time, but continues to evolve.
So as you go forth, maybe keep observing those market swings. Consider this provocative thought. How will this ongoing marriage of robust econometric theory, like the principles embedded in GARCH, and the power of advanced machine learning, truly reshape our understanding and management of risk in an ever more complex financial world?
Yeah, what new, perhaps unexpected insights might emerge when we effectively combine that deep theoretical understanding of market dynamics with purely data-driven predictive capabilities? Can we get both interpretability and superior accuracy?
Something to ponder. Keep learning, keep questioning, and keep observing the markets. Thanks for joining us on this deep dive.